In this video, I'm going to answer some questions that I've had from the community. So you can look in the comments box, you'll see the questions and timestamp, so you can jump straight to the question and listen to the answer, and I hope you find them useful. Question from Supersonic Boy 75. He says, if I convert a VAT elected office into residential dwellings, I've completed a VAT 164D on the purchase, will I have to charge VAT when I rent out those units that I've converted from a commercial property into residential dwellings? So if you bought the property, as you've said, you've submitted a VAT 1614D, you won't be paying VAT on the purchase. The VAT 1614D is your intention to convert from commercial to residential. You do that, you then rent out the properties, you don't charge VAT on residential dwellings, so you're okay there. That covers your question. However, there's a few other things you should be aware of in case you need to know. So if the vendor or the seller doesn't accept the VAT 1614D, because they can choose not to accept it, you can then pay VAT on the purchase price. And let's say you're buying the property for £500,000 and you pay £100,000 VAT. If you're converting it to residential, you can pay the 100 grand VAT and then not reclaim that from HMRC, but it's cost you 100 grand. You can you can reclaim the VAT and then rent out the units as commercial and charge VAT on the commercial property, and then you'd have to charge VAT when you sell that property. But that's not what you're looking to do. Your other option is reclaim the VAT, convert the flats, then sell off the flats. When you sell the flats, you don't charge VAT, but you can reclaim the VAT on purchase. So that works fine for you as well. Or you could reclaim the VAT, convert the flats, rent them out. There's no rent VAT on residential dwellings, so that's fine, but HMRC will want that £100,000 back, so they'll use the capital goods scheme to claw back those funds from you over the next 10 years. So you're giving the VAT back, so you're back to square one. What you can do is grant a long-term lease to a separate management company, which could be owned 100% by your existing company if you're buying through a limited company, and that will help you get around the VAT issue. But for you, it's simpler than that. Based on your question, you've submitted a VAT 1614D, so you're not paying VAT on the transaction. Convert the flats, rent them out. You won't have to charge any VAT on the rental income. You're fine. When you sell those flats, you won't have to charge VAT on the sale of those residential dwellings, so you'll be absolutely fine. So you've got nothing to worry about in terms of VAT, simply because there is no VAT on selling residential dwellings and there's no VAT on renting or the rental of residential dwellings. In this video, I'm going to answer a question which is, I just want to have 5 buy-to-let properties. Is it worth paying the extra money to have the properties in a limited company, or should I keep them in my personal name? Watch the video to find out. The answer is it depends. Because it depends if those 5 properties are unencumbered, which means you don't have a loan on them. Or it could be that they all have mortgages, so there's less profit for you, but then you've got section 24 to think about, depending on the overall income. So it's not a straightforward yes-no answer, in the sense that you can either have a limited company or not. So what you ought to be thinking about is, number 1, your personal income. Is it only from property, or do you have any other income? Number 2, are there mortgages involved? Number 3, is there any profit? If so, how much tax are you going to pay personally versus through a limited company in terms of corporation tax and personal income tax? Then, are you looking to grow your property portfolio, or you're just sticking to 5 properties? That matters too. So those are some of the considerations you ought to be thinking about when thinking, do I want a limited company or not? If the costs of a company are putting you off, and I'm just going to be very straight with you here, if the cost of the company are putting you off, maybe you shouldn't be in property. I'll tell you why. Because we're talking here about investing hundreds of thousands of pounds. So basically, if you're buying a property, on average, let's just say 150 grand, you've got 5 properties worth £750,000. and your question is about, should I pay the extra cost of having a limited company? Let's say a sole trader set of accounts for 5 properties. I'm just going to make up a number, cost you £1,000. A limited company might cost you £1,500. So £500, sometimes the difference might be £200 or £300 depending on which accountant you speak to. Is that really worth occupying your mind? I'd say no, and I hope that you don't take any offense to that. I'm trying to be helpful here to say maybe you're focusing on the wrong stuff here. £200, £300, £400 a year isn't really worth a big consideration when you're talking about having 5 properties and possibly more in the future. Hope that helps. Question from somebody which is, I'm looking to sell a property owned in my own name. Am I better off selling them all in one go or spreading them over a number of tax years? Watch the video to find out. This really depends, and from your question I'm assuming that all the properties are in your own name, so it depends what the total gain is. But you've got your annual exemption every year for capital gains tax purposes, so if you spread the sale over a number of years, you can use your annual exemption every single year, and that's going to help you pay less tax. Now, if the situation is where you and a life partner or a spouse both own properties together, then you can both use your individual annual exemptions for capital gains tax purposes, and in which case spreading them over a number of years is going to be helpful and useful. Whereas if you do it all in one year, then all of your income gets accumulated for personal tax purposes, so you'll have to pay, most likely you'll have to pay more tax than if you were to spread them over a number of years. So spreading it, the sale or part sale every single year over a number of years, generally speaking, is going to be more tax efficient for you. Of course, there could be some capital losses there, and that might negate some of the capital gain. I don't know your entire situation. I don't know how many properties you've got and why you need the cash, what you're going to do with the cash, all that type of stuff. Who owns the properties, in what share, in what proportion, whether looking at it, whether incorporating may work better for you and then selling them at some point in the future. All of those things are unknown to me. It's a simple, straightforward question, so I'm trying to give you a simple, straightforward answer, which sometimes can be dangerous without knowing the facts, but I'm trying to be helpful at the same time. So as a general kind of a blanket answer, you'll be better off spreading them over a number of years, because you and anybody else who owns the properties with you could use your annual exemptions. Question here from somebody which is, what kind of interest rate would I be looking to pay on a buy-to-let property? Is it around 4%? And the answer is, it depends. And it depends on which lender you speak to. So 4% is there or thereabouts. I've seen 4.5, 5, 5.5, 3.8. We've just done one for somebody who owns just under 70 properties in total with Aldermore, and the rate I believe is 3.6%. Fixed for 5 years. Doing another one at 3.8, seen some at 4.5, 4.6, 4.2. So 4% or thereabouts is about right, and if you get something for that through a limited company, then you'd be doing pretty well. Obviously, if it's in your own name, the rates are lower, but in a limited company, 4% is there or thereabouts. Question here from somebody which is, how do you make money investing in property when all the mortgages are always pretty much interest only? And it seems to this person that you might make a few quid on top, using their words, but because it's not a repayment mortgage, at the end you've always got the loan there, so they can't see how this whole thing works. Well, how this whole thing works is this: if you have a repayment mortgage, then you're paying the interest plus the capital, which means you've got to pay more money out. So let's run through a very quick example. Let's say you're getting £750 per month in terms of rental income. If you're then paying an interest-only mortgage of, let's just call it £400 to keep the numbers easy, that means you've got £350 left every month to pay some of the wear and tear, repairs, maintenance, insurance costs, if you have an agency costs, and the rest is yours. Of course, you'll have to pay tax on the profit. If you have a repayment mortgage, and let's assume that's £700 a month, you've got £50 left over to meet all the other costs, and you can't claim the capital repayments as an expense either, so you've got tax to pay too. So that isn't quite going to work for you in the scenario that I've shared with you. On top of that, if you own the property for a number of years, when you come to refinance, for example, you'll have bigger equity in the property. So let's say you bought the property for 100 grand, and in 5 years time you refinance and it's worth 140,000 pounds. When you refinance, you'll be able to get more money out of that property and use the extra funds to buy more property. So I get your point in the sense that you'll always have a mortgage there because you're only ever paying the interest, but you're creating an income stream by having regular cash flow, and then what you're doing is creating capital value over a number of years, which is the extra equity that you get, which you can refinance, pull your money out, and then or invest in more property, so you keep building more assets. But you're absolutely right, you'll always have a loan outstanding on that asset. Then that depends on your personal attitude towards debt. If you're not comfortable with having debt, you're not probably going to sleep easy at night, or you're going to keep asking the same question again and again. If you see it as a pure investment and a business decision, as in I own assets and I've got liabilities against those assets, which are my mortgages, so what's the net worth, and from that net worth, how much money am I creating every single month in terms of cash flow? Am I happy with that? If you are, it's going to work fine for you. If you're not, then you might want to think about paying off those mortgages, but you're going to have to come up with extra cash in order to do that. Question here from somebody, which is, what is the purpose of refinancing the house after the refurbishment? So here the person asking the question is referring to the BRR strategy, where you buy, refurbish, refinance, and then rent out the property. And the answer, quite simply, it's a simple answer, is usually you'll either have bridging finance or some other form of finance on the property, which could be quite expensive. So you then go to a traditional lender, i.e. to get a mortgage, and repay the initial finance, and obviously end up with cheaper financing or cheaper funding, which makes it easier for you. And depending on how much value you've added, which lender you've gone to, you can then pull all your money out, sometimes pull extra money out. Harder to do on a single let, much easier to do when you're doing large commercial conversions. And on this channel you'll see quite a few different videos of projects that I've done, where I've shared with you how we've been able to pull all of our money out and sometimes get more money on top. So simply is to get all your money back, and then obviously use those funds to repay any people or companies you borrowed money from, or any of your own money. You can pull that out as well and recycle that into the next project. Simple as that. Question from somebody, they're saying they have a SIP and they've been told if they draw down £12,500 every single year, they don't have to pay any tax because they can use their personal allowance against it. Let's find out. The answer here is it depends on your overall income. So if you've got no other income coming from elsewhere, then you can use your personal allowance against your pension, which means you won't have to pay any tax as long as the pension amount equals your personal allowance. If it's less than your personal allowance, then obviously there's no tax to pay, and you can use the balance of your personal allowance to generate other income. If it's more than your personal allowance, so let's say it's £20,000 and you're using your £12,500 personal allowance, then the other £7,500 is taxable. So it depends on your overall income. So if you haven't got any other income, yes, you'll use your personal allowance. But if you have other income and you're using your personal allowance towards that, then you don't get another personal allowance just because you're drawing down on a pension. So you get one personal allowance, use it as you wish, as you please. If you don't use it, you lose it. You can't carry it forward, you can't carry it back. It's in the tax year, so use it. If you don't use it, you lose it. But you can only use it against all your income in one go. You can't have it £12,500 for different types of income. Hope that helps. In this video, I cover a question from Nag, which basically is asking that he's got 2 kgs of gold, which he purchased, and in an emergency, he's looking to borrow money, so he can use it as security. But if he doesn't use it as security and wants to avoid paying bridging costs or getting a bridging loan, if he sells the gold, what are the tax consequences? Watch the video to find out. If you have investments which you've held on to for a while, then you'll have to pay capital gains tax, which is simply worked out by what it's worth today or how much you've sold it for, less how much it costs you to buy, less any costs involved with buying, less any cost involved with selling, and then you work out the gain and you pay the tax on it. So in this particular example or question from NAG, basically if you've got 2 kgs of gold, which let's just make up a figure, which cost you, let's say £50,000. I don't know how much a kg of gold costs, by the way, I'm just using this as an example, but it cost you £50,000 for 2 kgs of gold, and you're selling it for now for £75,000, and let's say that £50,000 involved no costs, then you've made a £25,000 gain. You'll have to pay capital gains tax on that. You've got your annual exemption, which you can use against that. If there's husband and wife, for example, or 2 or more people who own it, then they both get an annual exemption each per year. So in this particular example, NAG, if it's you and your partner, spouse, who both own the gold, you'll use your annual exemption, he or she will use their annual exemption, and on the £25,000 gain, you'll have a very tiny bit of capital gains tax to pay. So pretty much there'll be no CGT for you whatsoever. However, if you're in the business of trading in gold, i.e. you buy gold and then you sell it on, that becomes a trading activity, in which case you'll have to pay income tax if you're a sole trader or a partnership, and you'll have to pay corporation tax if you're running that business through a limited company. But looking at your question, pretty much you've had the gold for a while, whether it was purchased or inherited, and now you're selling it, so you'll be subject to capital gains tax depending on the total value of the gain.